Hello everyone, this is Anka Metcalf with TradeOutLoud.com, and today I will be talking to you about why retail traders stop out so often out of trades and eventually penny themselves out of very good trades. Today was a very good example. I called a trade on Twitter, and the trade was in the M&E S&P 500. And after it did a rocket bar to the upside, it corrected and it meandered into this area until 10 a.m. into reversal time. The trade was called this morning at 10 o'clock at 10:02 a.m. to be precise. So right here, you see my timestamp. I have a 5-minute chart. I can move to a 2-minute chart so you can better see where we got in. Okay, the trade was called at 10:02, so I'm going to go back in time into 10:02. Here it is. The trade was called long over 2262. Now, when I call a trade long, 2262 is the area where a lot of where the pattern sets up. That doesn't mean that where the pattern sets up is your entry area, because you need to see the price move and test that area before you get in. It's very easy. You see the pattern and you want to let the price prove to you that it's ready to break out of that price range in order to continue higher. Other than that, we could have jumped in here and we would have had a very high odds, very low odds trade. Like 0 odds of succeeding, right? Because at this point, if we would have taken the trade at 2262, or think, you know what, I'm just going to jump in here since she called the trade, is trading right here, I'm going to have a very tight stop. It doesn't work that way. You need the price to move into a certain direction for you to have a good assessment of the trade. And you need the price to prove that it can literally move higher and trade above the called price. So this is the reason why you have a trade parameter saying long over 2262 in this example, because you need to have the price break the barrier, prove to you that it's going to go higher. All right. It's one thing if I can call the trade at 2262, but how many traders can literally get in at the exact price? If you call it over 2262, it means that you can take it at 2262.25. You can trade it at 2262.50. You can take it at 2262.75. You can even take it a point or even 2 points higher. It's fine as long as you take the price above that range. Nobody is going to get in at the exact price every single time because you're not going to be capturing it. So this gives you a little wiggle time. All the professional and institutional traders on this planet are doing this. If you're getting in trades ahead of time, saying, you know what, she called it at 62, but I'm going to jump in here at 61 because I have a less of a risk, you're doomed. You're never going to make it as a trader, and you're going to penny yourself because you don't have the price that is going to go firm that the trade is going to go head your way. Okay, so it's enough that we have a lot of unknowns in the market, right? And the unknowns are the economic releases that are going to pop up. All right, so let's talk a little bit about the stop. The stop for this particular trade was 2258. Okay, now I sent out the parameters. Everybody that is into my program and everybody that took my education, and the Signal program is actually designed to help my traders know that when you have a stop at a support area, let's say like in this place at, let's say 2258, where's the trade? Okay, here it is. I'm gonna go back to the trigger time, 10:02, right? Okay, 10:02, this is the entry right here over this area, and this is the stop below 2258. All right, you see this area right here, the low of this candlestick is 59. That is the parameter. I'm going to give it a little bit of wiggle time, a wiggle room, not wiggle time. I'm going to give it a little bit of wiggle room. So my stop is going to be under 58. Why? Because all the retail traders, newbies, and novice traders are going to have the price right here because they think that support level is a set price set in stone. Well, let me newsflash, guys, it's not. Support, resistance are areas, and they're meant to bounce. All right, so if you don't give it enough wiggle room, you're going to be stopped out of trades every single time. The real stop in this trade should have been here, below the 56 area. Now, when I say below, you know the drill. You're going to give it a point or at least half of point. I usually give them about 2 points. I give them 2 points from the trigger price, above and below. Okay? I give them a little bit of room. And what I do look at, I never get out on red. Okay? And this comes from a fact that I was an institutional trader, so I never get out on red. Right? I know better than that. I wait for the price to pivot before I place a hard stop. If it goes against me, if I have a wiggle room, and if I don't have a hard stop in, I let it pivot. I let it pivot and I don't get out on red. I'm not a novice, okay? I don't get out on red. Am I going to get a flurry? No, because I know how to do my damage control. And I know that if it wiggles me out here, and if I don't have a hard stop in, I know that this is going to be my final stop. All right? The low of this candlestick from the open is 56, 22.56. So therefore, I'm going to give it, let's say, 1 or 2 points below this area, cushion area, for it to flurry down, form a pivot, and go back up. Because this is what price does. Okay? Now, the target was set at 22.72, and I'm not going to get into how you set entries, how you set stops, and how you set targets, because this is part of a course that I teach. But what I want to mention is that entries are trigger prices. Trigger prices are, and I think this is, we're on the same page here. I'm going to move to a little bit a larger time frame, so it's not as noisy as a small time frame. So what is the trigger price? Okay, a trigger price is your entry. Bottom line, like I said, if your trigger price, let's say at this point, let's say here, at this point, because you have set support here, let's say at 22.57.50, and you have a trigger price here at 59. Okay, you could take it at 59.50, 59.75, 59.50, all the way to 60. All right, this is going to be your entry above this area. Sometimes the trades are going to happen super fast, and you're not going to be able to have the 22.62 or 22.59. And then you know what the situation is, and in this case, you're going to set your entry 22, let's say 22.59, 25, 50, etc. Okay? Now, entries are always above the call price, and stops are below the call price. Why? Like I said, and I mentioned before, the low of a pivot, the low of a support area is not set in stone. Okay? It's not an exact price. And for this reason, I'm giving it 1 to 2 points. Now, when you position size for your trade, you have to make sure that you accommodate the wiggle room as well. So you take into consideration your entry, your stop, and your wiggle above and below. All right? One other thing is that if you cannot afford, let's say, the particular stop, if it has a wider stop than your position size, let's say, than your risk amount per trade, skip the trade. There's always going to be another trade lined up. So skip the trade. If you think that M&E S&P 500 is a little pricey and is a little bit wiggly, and to be very honest, I'm not a big fan of trading the M&E S&P 500. My favorite is trading NASDAQ and trading M&E Dow. But if something sets up in the M&E S&P 500, I'm not going to turn my back. So I'm still going to take the trade. So if the trade has too large of a risk for you, skip the trade altogether. If it's not in your plan, let's say to risk 500, let's say $250 with one contract. Okay. Now I have a lot of traders, and the amounts are various. Some traders are trading with one contract. Some traders are trading with as much as 7 contracts or 24 contracts. But I'm just saying, if you're trading, let's say if you're a beginner trader and just trading with one contract, you should be considering your size. So if your risk per trade, because it's very hard when you're trading futures to have this defined risk per trade. You have to have a larger risk defined per trade, so to accommodate the full contract, obviously. All right. So if it doesn't meet your plan, skip the trade altogether and wait for that, let's say $100 risk or $50 risk and so on and so forth. We're going to have a plethora of calls that we're going to make throughout. The other thing that I wanted to talk to you about is target areas. When we call target areas, most of the times you're going to see that we call 2, 3, or maybe 4 target areas. For those of you that are trading with multiple contracts and have larger accounts in size, what I truly suggest is that you take half of the position off at target 1. Target 1 is the easiest target to reach. You have the catalyst, you have the dynamics from day traders as well as swing traders, algorithms, etc. So you're going to get a very hard push to target 1. As you're reaching target 2s and target 3s area, what you need to do is layer out. So at target 2, you're going to layer out another quarter, and the last lot, you're going to start trailing it really nicely until the market takes you out. I don't want you guys to take yourself out of trades. Okay? Don't take yourself out of trades. The other thing that I wanted to talk to you is management. Okay? So trailing is basically management, part management, and also we can talk about the risk to reward here. And to be very honest, in the S&P, in this trade in the E-mini S&P 500, the risk to reward wasn't that great. And we did have the meeting minutes. We lived through the meeting minutes, and the stop held through the meeting minutes. However, if you're a beginner trader, try to develop very good habits. Okay, try to develop very good habits. And whenever you have like FOMC meetings or anything like that, or even oil numbers, don't be caught trading oil in the middle of oil numbers, okay? Because that's suicidal. You have no idea in which direction the trade is going to go. Technical pattern is going to mean nothing. Stopped out trades. A trade is considered stopped out only if it trades under the suggested stop loss price. So the stop loss price in this example was 22.58. But 22.58, give it, like I said, minimum 1 point to 2 points. Okay, 1 to 2 points. And you have to compute this when you position size for the trade. This way, you're not going to be stopped out. Okay? You're not going to be stopped out. And once you learn good trading habits and how to apply and not to literally freak out when you see a red bar go against you, and wait patiently because you have a game plan. All right. You know technical analysis. You know that, you know what? If this stop is not going to hold here, I'm going to give it up plenty of room. Look at this area, 22.55, 50. All right. This is the area. This is the gap up support from the E-mini S&P 500 this morning. Obviously, I took pre-market data off because I trade without pre-market data. When the market opens, I don't have pre-market data on. However, I do have pre-market data and one other time frame that I use for the rest of the day. Cancel trades. Let's say, for instance, we have a trade called today. Let's say 22.62. Let's take the same example, 22.62, and the price never reached that area. That doesn't mean that we're gonna have our limit order there in place forever. You know, if the trade does not develop and the trade goes against us, and if it violates the stop that was in place but never triggered, then what you need to do is just leave it alone. Cancel the trade. The trade is called cancel. And not only that, but I will definitely mention it on my private Twitter feed when the trade is going to be canceled. Okay. One other question that I have received, and what I'm going to do right now, I'm going to put extended hours. And Igor, if you're listening in, okay, this is the answer to your question. And guys, if you have any other questions, feel free to private message me with the question, and we'll do a video and we'll get back to you. I want to make sure that everybody's successful and everybody knows how to trade like a professional trader. Not only that, but I want you guys to beat the institutional traders as well. All right, so let me go to futures. I'm going to highlight these areas. All right, so I'm going to move to a bigger time frame here. because Igor saw that 2262 area is kind of like a good support area for the mini S&P 500 to move higher. And I said, it's not ready yet. Why is it not ready yet at this point? So we have the 2262 area right here. We want to have a consolidation at this area because one candlestick that is moving into this area, and you can see that's a little bit extended from the moving averages, and it's a little bit extended from its prior support areas here. And I'm looking at these resistance areas, and if you know anything about technical analysis, you would see that these areas right here, okay, let me just move it a little bit to this side. All right, let me just take a drawing tool. Okay, you can see that these peaks right here was what once was resistance now becomes support right here. So we could actually have a pullback all the way to 2255 here. So we may have this pullback. We're going to see if that's going to happen. But so far, we have support that is sitting here. Please ignore that line. All right, so we have support that is right here at 2262 area. And a trigger in this case is 2264. So this is the new trade, and Igor, if you're listening to this, 2264 is the entry and the stop is 2262. What that means is that your entry needs to be above 2264. That is 2264.50 or 2265. Obviously, right? Because we're going to give it, we want the price to prove that it's moving in our direction. Okay, number one. Number two, the stop in this particular case is 2262. So what that means, am I going to put the stop here like all the novices at 2262? No, I'm not. I'm going to give it at least 1 point. At least 1 point. I usually give, like I said, I mentioned it before, 1 to 2 points. All right, so you give it a little bit of wiggle room to the downside, because at this point, every novice on the planet is going to have its stop here. And what happens is you're going to see a flurry to the downside, and then you're going to see the trade move your way again after it flurries to the downside. It takes everybody out, and then it continues higher. I don't want you guys to be the bottoming tails, and I don't want you guys to be the topping tails. Okay, this is the secret behind why retail traders stop out so often. So thank you for listening. And once again, if you have any questions, feel free to email me at info@tradeoutloud.com for more details. And if you think that tonight's video was helpful, give me a thumbs up, or shoot me an email at info@tradeoutloud.com with new suggestions. Hope you all have a very nice evening and a very profitable trading day tomorrow.